Today, I want to share how I plan to manage my cash in 2025 based on the different types of liquidity. There are three different types of liquidity I consider: the emergency fund, the liquidity for short-term investments, and the liquidity for middle-term investments. Since the European Central Bank lowered interest rates by another quarter point a few weeks ago, bringing them down to 2.75%, I need to define a strategy for my liquidity in 2025 based on its intended purpose. If you are also wondering how to handle your cash in the coming year and feel unsure about the best approach, I hope this video might give you some ideas or inspiration. Stay with me. On one end, the drop of the interest rates is a good news, as mortgage rates, especially variable ones, have become extremely expensive, making it difficult for many people to keep up with their payments. On the other hand, as investors, we had grown accustomed to earning returns on our cash through bonds, money market funds, or cash deposits, something we had not experienced in years. In just a short time, we've gone from cash is trash to cash is king. How did we get here? After COVID, central banks lowered interest rates to 0% to stimulate the economy and prevent a recession. While this helped support economy recovery, by 2022 rising raw material costs led to higher inflation. In response, central banks began increasing interest rates. Raising interest rates make it more difficult for investors and businesses to borrow money, which in turn slows down investments and economic activities. As demand decreases, businesses are forced to lower prices to attract more customers, leading to a gradual decline in inflation. To better understand how to manage our liquidity, we first need to understand what might happen to interest rates in the coming months. Of course, none of us has a crystal ball, but we can look at the Euribor index for some guidance. The Euribor index, in fact, is the rate banks use to lend money to one another. If we examine the 12 months Euribor, we see that it currently stands at 2.4%, suggesting that the market is already anticipating a further half-point reduction in interest rates over the next year. However, this is merely an indication, as the central banks may adjust their policies in response to unexpected events. For example, in the US, the inflation is currently rising again, and to counteract this, central banks might decide to raise rates instead. Okay, now that we have an indication of what might be the interest rates in 12 months, we can start to do some assumptions based on the different types of liquidity. Let's start with the first one, the emergency fund. When it comes to my emergency fund, accessibility is the top priority. This cash needs to be available at any time in case of unexpected expenses, such as a car repair or a broken household appliance. Since emergencies require immediate action, I cannot afford to wait weeks or months to access these funds. That's why, in this case, I prioritize liquidity over higher returns. I willingly accept a lower yield in exchange for instant availability. My two preferred options for storing emergency funds are free cash deposits, also known as on-demand deposits, and money market funds. The free cash deposits are bank deposits where funds remain fully accessible at all times. In Europe, a deposit up to €100,000 are protected by the deposit guarantee scheme. The interest rates vary based on central bank rates and are paid out regularly. Some banks and brokers pay interest monthly, while others do so quarterly. The money market funds, instead, are exchange-traded funds, ETFs, designed to mirror central bank interest rates, offering an alternative for short-term liquidity management. Let's compare these two options. The cash deposits offer interest rates that vary depending on the country, bank, or broker. Some brokers even pay interest on uninvested cash. Generally, cash deposits yield slightly less than money market funds, but there are exceptions. For example, Trade Republic directly matches the European Central Bank's interest rate. At the time of recording this video, Trade Republic is offering 2.75% per year, paid monthly with no additional costs. At the same time, this money market fund has returned 0.21% in the past month. If we annualize this return, 0.21% multiplied by 12, we get an expected yield of 2.51% per year. However, from this value we must subtract the total expense ratio of 0.14%, and of course, this estimate does not account for potential interest rate fluctuations. It's simply a snapshot of the current performance. For this type of liquidity, either option can work, but I personally prefer cash deposits. The main reason is that in Europe, deposits are protected up to €100,000, and with my broker there are no additional costs, making them a safer and more straightforward choice for an emergency fund. Another type of liquidity I always want readily available is cash for short-term investments. This is money that I intentionally keep uninvested, ensuring I have the flexibility to seize market opportunities as they arise. For example, I want to be ready to buy Apple stock as soon as the price drops below $200. In general, whenever the market dips, I wanted to have cash on hand to act quickly. Similar to my emergency fund, this liquidity needs to be instantly accessible because market opportunities can be short-lived, sometimes just a few hours or days. Once again, availability takes priority over earning interest. To keep this cash both accessible and slightly productive, on-demand cash deposits or money market funds remain, in my opinion, the best options. They ensure my money is always within reach while still earning a modest return. Now, let's look at the liquidity for short to mid-term investments, funds designed for investment opportunities within 2 to 5 year horizon. I would not consider a longer time frame here, as that would push me toward a more balanced portfolio with greater exposure to stocks and some level of risk. For this type of liquidity, one potential solution is a time deposit. This is a special cash deposit where funds are locked for a fixed period in exchange for a stable guaranteed interest rate. However, unlike an on-demand deposit, the money cannot be accessed freely. Withdrawing early may result in penalties or fees. Just to make you an example, here are some of the time deposits I found available here in Germany. Of course, you should always do your own research based on your country and financial situation. Nevertheless, in this scenario, there's also another option to consider: government bonds. For a 3-year time frame, government bonds currently offer slightly lower interest rates than time deposits. However, there's an important factor to keep in mind. In a declining interest rate environment, bond prices tend to rise. Predicting exactly how much is complex, as it also requires calculating modified duration, a formula that measures how interest rate changes affect bond values. That said, in this scenario, government bond could potentially deliver returns comparable to or even slightly higher than a time deposit. I currently keep this liquidity in a time deposit, as I secured a good offer from my bank at a 3% interest per year almost 1 year ago. This time deposit will mature in 2026. After that, I will reassess my options based on the market conditions at that time. Now, let's recap. Emergency fund, either a money market fund or an on-demand cash deposit. Short-term investments, again, either money market fund or on-demand deposit from banks or brokers. Investment within a 5-year horizon, a time deposit or a government bond that should do the job. That's it, guys. Hope you found this video helpful. Now, I'd love to hear from you. How do you plan to manage your liquidity in 2025? Share your thoughts in the comments here below. If you enjoyed this video, you might also like this one, where I analyze 100 hours of YouTube content about Bitcoin. Definitely worth checking out. Alright guys, thanks for watching and I'll see you in the next one. Bye!